There are traps laid out by professional hedge funds in order to bait retail traders to enter early so that they can engineer liquidity. So the third step is that before you actually enter for the trade, right, before you start entering for a buy right here, you want to wait for some form of liquidity sweep and structure shift. Right, here's what I mean. You can see over here, we have identified our swing low and swing high. So everything in between is an internal structure. And you can start to see that the internal structure started shifting bearish once again to do what? To facilitate the higher time frame swing pullback. So over here, when price start creating these lower highs and lower lows right here, we know that it's just bearish in the short term. Right, so we can keep track of this. And what we want to see is the internal structure to shift bullish. Okay, so over here, you can see price comes down, creating a lower high, continues creating like an internal bearish break of structure, and then later on price goes up, pulls back, goes up. What do we have here? We got an equal lows, double bottom. This is a very common chart pattern, and it's also an inducement trap. So what happens is that a lot of retail traders, they see price mitigating this demand zone right here, and then they see this double bottom pattern. This is where they enter for a buy. And we know there is liquidity, right? There's going to be a ton of liquidity sitting below these lows. So you want to wait for that to be swept before you even consider looking for an entry, right? So in this case, later on price comes down there, sweep the available liquidity below these equal lows, mitigate our higher time frame demand zone, and it's also at our extreme zone, which is our last line of defense, which has to hold in order for the higher time frame structure to remain bullish.